You can buy in the perfect suburb, but if you buy the wrong property, even in the right suburb, that property is not going to perform, right?
If you're purchasing and you're putting in a 20% deposit into a property and you're mortgaged up to your hairline to be able to hold this, I don't think it's a great idea to do it. Your ability to then create a portfolio outside of that is hampered because your serviceability is hampered. Hi everyone, and welcome to Helpmebuy Property Podcast. I'm your host Cheryl Leong, and with me my very gallant host Moxin, Reza. Drum roll for the man himself. How are you doing, Moss?
I am amazing. I am awesome. How about you, Cheryl?
Always good when we're talking about property, and especially when we're talking about really fancy blue chip properties. Our topic today, and this is part of our new segment of Myth or Bust. It's like we're the myth busters. The questions that we get asked time and time again, or topics that come up time and time again, should I buy premium blue chip property? Is that the best way to go?
Definitely. And actually, there is this notion around expensive or negatively geared properties are the only way to create wealth. I heard this on one of the podcasts, or I think one of the reels, where the person was saying that, high-rise Harry, who is the Australian's richest billionaire in real estate developer, you don't see him buying, properties in cheap regional towns to create wealth, and he's buying it in core Sydney and Northern Shores, and that's how he's creating the wealth. And so why are you going there and buying in regional towns? So you are buying their affordable houses, sub $400,000 or $600,000 properties. So it's an important argument to play, right? And so that's what we are going to do today. We are going to play that argument of the pros and cons of buying in blue chip areas, or should we be investing in blue chip areas at all, like typically?
That's such an interesting argument, because I guess the person that's made that comment is only seeing, let's say it's Harry Triggerboss portfolio in a tiny little segment, when Harry's got a whole lot of built to rent as well. You can see it's part of a larger portfolio strategy. Yes, you've got high capital growth and equity and value, but yet you've got another part of his portfolio that is incredibly high yielding, cash rich, right? So you can see where it's possibly balancing out his portfolio as well. So yeah.
And it's a typical high net worth example, right? I think, my comment to my own self when I was listening to that was, well, Harry was never always a high-rise developer, right? And so what about that Harry who was 20-year-old? And how about you go and check that Harry out and see what he was doing when he was 20 years old, right? Don't look at Harry who is 60 years old and a billionaire and buying in, Sydney or Melbourne or rich areas. You need to see where he started.
He was sort of, if I'm not wrong, he was renovating sort of blocks of old apartments, right? And that's where you've got to start off. You don't start off, wake up one day and you're building, 50 level apartment blocks. You don't do that. You've got to build up from there. So definitely.
So for the user's sake, let's talk about, or let's define what is a blue chip expensive property. Let's try understanding the definition of a blue chip property, because not a lot of people understand that. From my perspective, when you talk about blue chip expensive properties, these are properties within major city center radius, like 10-15 kilometer radius, or one of the most wealthiest pockets of major city centers, be it Melbourne, Sydney, or anywhere else, be it Byron Bay, right? Could be anywhere. But typically, you are looking at properties which are significantly higher prices, and the yields on these properties are significantly lower, sub 300 or 3%. I would say below 3%, not even sub 3% in majority of these cases. And that is the definition of expensive blue chip property that we are talking about in today's conversation.
Yeah. And typically they've got a really high percentage of owner occupiers as well, right? So in terms of the supply in those areas tend to be quite tight, but the demand is also very, very strong because of the convenience and everything else.
Yes. And I think that's a good segue in talking about the pros of buying into these properties, right? You talk about a high-end market, which is like 5, 10, or even 15 million market, right? These markets don't see typical property cycles, right? Because you're not talking about an average Joe Bloke Australian, who is, scared of, a 1% interest rate, right?
Interest rate rise, yes.
So these markets don't move because of interest rate rises. Yes, the market might stabilize, but you don't see negative growth in a lot of these areas, or you see negligible, a negative growth in a lot of these areas. They're very stable, long-term, mature markets. So that's definitely a pro in investing in these areas. It's almost like it's a safe bet, right? You buy in this area and it's a safe bet. You can never go wrong, in buying this area because they're tightly controlled, they're owner occupied, the demand is there, the schools are great. People would always be wanting to live in there. These are like Turex and the Brightons of, Melbourne, or Sandringham of the Melbourne, or you talk about the North Shores of Sydney. It's those premium pockets which are never going to change. Or the gentrification is already high up there and it's not going to go backwards, right? It's not that all of a sudden people start becoming poor in these areas.
Even in a GFC, yeah.
Yeah, exactly.
Yeah.
Yeah. In fact, in GFC, because they are high astute investors themselves, they actually be a lot more aggressive and they upgrade their homes because they know that no one is buying, right? And so they try to find these, what I call these is, these ugly ducklings where this wrong person has entered the suburb and they're trying to pretend rich. And now they're feeling the wrath of being in that suburb and they're trying to, cash out. And these people are like, oh yeah, I'm going to buy you out. It's not a problem. So basically you see those stories.
$40 million. I'll tell a really short story. A friend of mine from overseas, and he's like, oh, I've got a investor that's looking to buy a property in Australia. And I joked, I said, I hope he's got deep pockets. And he goes, yeah, he was looking to buy a $45 million house in Singapore. I'm pretty sure the money's not the issue. I went, okay. So it's like those sorts of buyers that you're generally dealing with the really high-end prestige blue chip properties. But what we're also seeing there in those areas is we talk about sort of a more stable level of growth. What we also see that if you're buying in a blue chip area, and I'm talking about an area as opposed to the property itself, you're buying, as they often say, the worst house in the best street, right? There's always this potential for an incredible amount of manufactured growth in that area as well. Because you have a property down the road that's sold for $5 million. You've got a crappy old house that's maybe $2 million. Still a good lot of money. But, there's a $3 million difference there. You could knock down, rebuild, and you got a $5 million house.
Typically, you think about why development works in these areas is because of the guaranteed growth, these price discrepancies of an old house versus a schmick-looking, nicer-looking house, right? And you were joking about this, rich people pay for convenience, right? And this is the premium example of convenience. They don't want to buy an old house, spend $700,000, wait for a year, go through the hassle of, fighting with the builder, because they're overcharging.
Not like us plebs.
Yeah, they don't want that hassle. They want to basically, bring in their Chanel bags and just walk into the house and say, okay, this is one bag for you for $15 million and shush away and we are going to move it, right? Basically, that's the mentality of these people, right? And I'm throwing that picture out there for people so that, people can understand that this is the area that we're talking about.
It's a bit of a generalization, but, we're invoking the...
Okay, maybe not Chanel bag, maybe a Tommy Hilfiger bag. Let's.
Oh no, that's not. Either way, we're painting a very generalized picture of the image of the fact is that there's not as much of that mortgage stress that we're talking about because generally at that level LVRs are really quite low. Potentially as well, there's a lot of old money in these areas. So you've got properties where they're older properties, incredibly, expensive properties that have probably, were purchased for $50,000 like 50 years ago, $4 million. So you can see there where there's an incredible amount of wealth in the property itself. But you'll find that the people that are there will often be quite asset rich. If you're talking about old money, asset rich, but cash poor. So the pros of purchasing in these areas is that, one, we mentioned, potentially being able to manufacture growth a lot easier because there's often a big discrepancy between the crappy old house and a renovated house. So big pro there. And some other things in terms of, because they are in nicer locations and everything else, well, you tend to think there is a higher demand for that type of property. However, when you get to a point when we'll talk about the cons, yes, you've got a better product, but then on the flip side, if it's too unique, then you potentially are narrowing your market as well. Any other pros that you can think of before we move on to the not so pro bits?
I think the last one is more in relation to the safe, stable, predictable rental markets. And so, you would always find it easier for tenancies to go through. They are really low on vacancy rates because they are super gentrified, high wealthy areas. And you would get tenants quite easily in some of these pockets anyway. And so while the rents are low, the vacancy rates are quite significantly lower as well. And so you don't see a massive turnover of tenants typically in some of these areas. And so, and I think that's a good segue into talking about the cons as well, right? So because the rents are low, while they're consistent, they're really, really low, which means that these properties are significantly negatively geared, right?
And just to preface it, when we say low, compared relatively to the value of the properties.
Yes.
So, for example, we went to see this incredible property, oceanfront property, which was a good $6 million or whatever. I think it might have been a bit more than that. Ocean views and all. It was renting for $2,000 a week. You think about that and you sort of go, what are my numbers? Like it's almost like a no-brainer. But they had to, because at that level of property, there's such a smaller number of people that are willing to rent at a really high level, right? In which case means that the market needs to come back. And so you find actually there's more discounting to a certain extent to make it more affordable for people who can rent those properties. But you're right, they're significantly negative geared. And so the argument around buy where you want to invest and live and rent where you want to live in those situations really makes sense, because if you're living and renting a $6-7 million house for $2,000, I mean, people who are paying $8,000 in mortgage at the moment, I think that's probably like a house that's 1.5 million.
Definitely. And it's a tick on both sides, right? You're creating a lifestyle for yourself and, you're creating wealth for yourself on the side as well. That's why rent vesting is becoming quite sort of popular these days as well, right? But coming back to the negatively gearing side of things, just to provide people a bit of example in relation to some of these things, that negatively geared is what, a lot of property advisors or buyers agents would push it out there that, they're negatively geared, but there is consistent growth. Understand that these properties could cost somewhere around like $70,000 per year in holding cost in today's rate, right? And if even like 50% of this is offset by rent, you're still talking about $35,000 worth of expenses of holding this property, okay? Now, the important thing about these properties is, or in these pockets, is that you buy, say, $3 million or $4 million property, it's not going to become a $6 million property in 7 years' time. There is mature growth, which means they grow by like 4%, 5% every year. Yes, there is predictable and guaranteed growth almost, but it's not magnanimous growth. It's not, with a higher magnitude growth, which basically means that if your holding cost is, say, $35,000 a year in out of pocket before taxes, say, for example, if you're holding this for 10 years and, this property goes to, say, an extra, $900,000 in increase in value, for example, you have basically paid close to about $400,000 in holding cost, right? And so you need to understand that, while your property value has gone up by 900, your net impact is still like 400 over 10 years, right? Because you are so significantly negatively geared. A lot of people don't think about these things. They don't think about this leakage of money that is happening on a year-on-year basis. They completely forget about it. They say, oh, I bought a property for $1 million. I'm selling it for 1.5. So I've made $500,000. And be like, no. That's not the true comparison. What was the out of pocket that you paid in holding this property? And you need to add that when you're taking out your profit or your walkaway in relation to some of these properties. And that's where the deal breaker happens, right? People who are on higher tax brackets who are earning like $300,000 a year, cash flow is usually not a problem. And so they get sucked into these properties because they're like, oh, it's only $35,000 a year. I can hold this. But what they don't realize is that in the long term, the opportunity cost of them not getting the return or, that magnanimous growth is something that would basically take them backwards in creating the wealth for themselves.
Yeah. So who's paying $35,000 a year in interest in these places?
Oh, crazy. There is a lot of people like I know one of my clients, and I kid you not, he's out of pocket right now. He has 2 properties, both of them significantly negatively geared. He bought these properties when, the rates were at 2%, these properties were sitting at 3% yield. And they're like, oh yeah, this is great. And these are not even like $4 or $5 million properties. I'm talking about $1.5 million properties, by the way. 2 of the properties, you do the maths, he's paying roughly about $70,000 out of pocket every year from his disposable income.
You're talking about expenses, like overall expenses and net.
Yeah, net. Yeah, going out of your pocket. Yeah. Yes. Yeah. And so it's really painful. And at the start, it wasn't that bad, right? Because in 2% interest rate, 3% yield, it's almost negatively geared or neutrally geared rate. The rate starts rising, and then all of a sudden you can see the wife getting frownier and frownier every day as to what decision have you made here.
Frownier. That's not. Don't look it up. I really don't think that's.
Sure that's not the word.
Yeah. Frownier, not a word. Dare I say they're not particularly impressed with the financial situation of that property.
What else, Cheryl, if you talk about the concept of, buying these negatively geared properties?
Well, I think we touched a little bit on in terms of the higher entry cost to actually buy in. You see, the stamp duty to buy into a multi-million-dollar property is a few $100,000 on its own. So there, you need to make sure that if you're going to purchase in these areas, first that it's sort of investment grade, that long term, that you're not purchasing in an area that's a dud, even though you're in a particular suburb, that the property itself needs to be in a good spot.
A very important point. Yes. Yeah. You can buy in the perfect suburb, but if you buy the wrong property, even in the right suburb, that property is not going to perform, right?
Yeah.
So, yeah, 100%.
Absolutely. And I think the thing that a lot of people might purchase into, and I believe this is relevant for anywhere really, is that, if you're purchasing and you're putting in a 20% deposit into a property like this, and you're mortgaged up to your hairline, right? And you're having to sacrifice your lifestyle to be able to hold this, I don't think it's a great idea to do it, because it actually then means that your ability to then create a portfolio outside of that is hampered, because your serviceability is hampered. And you're waiting for capital growth to be able to get there, which capital growth might happen, but the fact is that because you're max to the max, your serviceability is not there to be even able to to take advantage of that capital growth.
And this mindset, this is a very old school mentality, right? Where I'm going to kill myself today in order to hold a property portfolio that is significantly negatively geared till I hit 60 or 70 and I retire, and I'll sell one of these to basically make a living for myself. Even if, a $2 million property becomes $4 million by the time you retire, say 50 or 60, $2 million by the time you hit 60 is not worth that $2 million. It's not enough to provide for that retirement, right? I was giving that example to a client that, imagine that you're 60 and you're trying to retire and, you have a net worth of $1 million extra, and you live till 95, you have an extra, 30 years of 35 years to live. And, that $1 million is like $30,000 a year, literally, right? Can't live on that sort of money. So it's important that the scalability and sustainability becomes significantly hampered, because typically what you're doing is you're putting all your eggs in one basket, right? And so the benefit of diversification is what you're not going through. And I always use this example for people that, if you are in this, everyone is in the property game from a long-term perspective. That's true. There is nothing wrong with that. But then why blue chip suburb? Just buy graves, right? We use this example numerous number of times that, graves go up in value significantly more than a blue chip property because, hey, the demand is never stopping. Hey, and the supply is significantly crunched. So, that mentality needs to change.
Your tenants don't make any noise.
Yeah. 100%. I love it.
Yeah. My mum joke for the day. I'm very proud.
So, yes. And I think one point that you originally made, which is a very strong con for a blue chip property, is that you have a really small portion of buyers and sellers. And in a crunched market, that portion of buyers and sellers can be really, really picky, right? And so they might not like the color of your facade of the house, or they might not like the tile in the bathroom. And they would discount that quite significantly on the price point, because as Cheryl said at the start, that the discrepancy between an old ugly house and a brand new house is massive. And so if someone sees your house as an old ugly house, no matter how nice your house is, because they perceive that value as a lower amount, basically that's it, right? Because you have such a small pool of buyers.
Yeah, absolutely. Well, Moss, you didn't do the honors of doing a bit of a wrap up. Does it mean that we shouldn't buy blue chip properties or at all, or is there a better alternative, or what's option C?
Look, typically we are not saying that you shouldn't buy blue chip properties, right? There is a place and a space in your property portfolio of buying, these properties. I always say to people that, you don't just focus on positive cash flow property and stay away from negatively geared property, because then you would never invest in Melbourne and Sydney at all, because everything that you touch in today's time in Melbourne typically is negatively geared, or Sydney today is negatively geared, right? The idea is that your overall property portfolio needs to be sustainable. And so you need to generate enough income within your property portfolio that these negatively geared properties are catered for as part of your overall property strategy, right? And that's the most important thing. That, yes, they are safe bets. And so why wouldn't you want them in your property portfolio? Especially if you have multiple exit strategy or development potential in these properties, they are perfect. They have a perfect place in your property portfolio that you can develop them in the future. You can do a lot more with these properties, but it's important to create that sustainability around these properties to make sure that there is enough buffers in place to protect your lifestyle, right? The other important thing to understand is that you don't start off your property portfolio with a blue chip property. I think that's the rule of thumb, right? You don't start off with a negatively geared property, because then, as you mentioned, you're going to crunch your serviceability completely in order to scale up your property portfolio, and you're going to lose that lifestyle as well. The idea is to start off in areas which are going through gentrification, which are going through infrastructure changes, which are going through a lot of these population growth, and they're still owner-occupied areas. There is this stereotype that owner-occupied areas are only in rich suburbs. That's not true. There are areas which are going through gentrification, going through massive mortgage affordability changes, and people are, reaching higher echelons of income levels, and they're still very occupied owner-controlled areas. And so if you buy there at sub 600 price, but focusing on higher yields as a first-time investor, then as part of your experience investing strategy, you can add blue chip properties with development potential, blue chip properties with multiple exit strategy into your property portfolio, and makes it a lot easier for you to hold and enter into some of these more pricier premium markets. And you can be the next Harry high rise, right?
Yeah, Harry or Moxin or whichever you like. They said, yeah, again, I think we've talked about this as a quick summary in terms of, it needs to be part of an overall investment strategy. Probably not a great idea to have one blue chip property and that's it, and and not much else, because that's not a very diversified portfolio. If you've got a diversified portfolio, you've got 20 properties and 2 of them are blue chip, the rest are all different types of assets and so on and so forth, then, throw a few in there. But more importantly, it's your strategy, your long-term view, your risk tolerance, and again, where it sits in your portfolio overall.
Definitely. And if you have any negatively geared properties in your property portfolio as a viewer or a listener, and if you want to share your story with us, whether it be through an email or drop into the comments or reach us on our Facebook page, on our own personal profile, that would be great. Share your story with us. Reach out to us. It would be great to understand as to how did you navigate higher interest rate environments with, super negatively geared properties, and what did you do differently with your property portfolios?
Yeah, absolutely.
Thank you for listening to us. Take care, stay safe, keep smiling, keep investing. This is Cheryl and Moss checking out. Adios.
Take care. Ciao, ciao. Bye-bye.